Hi, everybody. Welcome to today's webinar, January 2017 Shipping Prices at a Glance. My name is Catherine Barrios. I'm CMO at Xeneta. I will be your host today. I'm joined by our CEO, Patrick Berglund. Patrick, if you could move to the next slide, that would be awesome. Thank you. And let's see. We are soon moving to the next slide, but nonetheless, Patrick is today's host and presenter. There's a couple of housekeeping items that we wanted to focus on for today. This is a 25-minute webinar. We'll reserve the last 5 minutes for Q&A. We ask you that you please use the webinar tool to ask your questions. On the right-hand side of the tool, you'll see a little area that says questions, and you can drop in your question throughout the webinar in there, and we'll do our best to answer them throughout the webinar. If we don't get to your question, we'll answer it over email. Also, to note, we are recording the webinar, so everyone that has registered will get an email with a link to the recording later by tomorrow. We really encourage you to share the recording with your colleagues and over social media. Actually, and if we just go on to the next slide, there we do encourage you to join the conversation over Twitter. We are at Twitter handle at Xeneta_AS, and for today's webinar and for all the webinars that we have at Xeneta, we will be using hashtag X_webinars. We encourage you can drop in questions there if you like as well. Any other facts or tidbits that you find from this webinar, we encourage you to share those with your social media followers. Now, if we move over to the next slide, I'll walk you through a little bit of what we'll discuss in today's agenda. We have a lot of people registered for today's webinar, which is a great number for us, and we have a lot of new people as well to Xeneta that haven't joined us in the past. Therefore, we'll go through an overview of Xeneta, our data, how we collect our data, some of our key strengths. We'll then move into current state of the market, what's in store for 2017. We'll show some main highlights for the Q4 2016. Then Patrick will jump in straight into a live demo of Xeneta. We'll focus on these two main corridors, on short-term rates and also long-term rates, some findings, some interesting information that you can take back with you. And throughout the demo, Patrick will also be giving some outlook and closing remarks. Overall, what we foresee, a little bit for Q1 and some historical rates as well for the last quarter. Then we'll move into some Q&A, as I mentioned, and we'll close off the webinar at that point. So now we're ready to get started. So without further ado, I'll move it over to Patrick, and he'll focus on today's webinar. Thank you. Welcome, Patrick.
Thank you, Catherine. I appreciate the intro. So first, as Cathy mentioned, a little bit of the basics of Xeneta. We're an Oslo headquartered company with offices now in New York and Hamburg. And we built an online benchmarking platform that sources data from BCOs, shippers mainly, but now also some of the supplier side companies and mainly NVOCCs. We have more than 700 companies, large enterprise companies connected to the platform, and more than 2,000 users. Now, what's key to understand about the approach we've chosen to build our benchmarking tool is that we've built a technology company that allows a lot of parties to connect and upload fresh data all the time. So when we hosted our latest webinar, I believe we had a database of 17 million contracted rates in it. Now it's grown to more than 23 million, and it's growing very aggressively as new companies join the platform. This data is crowdsourced worldwide, but we key target larger volume BCOs, but our user base is built up by anything from 500 TEUs per annum to more than 500,000 TEUs. Now, with this set of data, we're able to cover more than 160,000 port pairs globally, which means that we can release benchmarks and price development historically on 160,000 port pairs. Data is poured into the platform on a daily basis, and we have a dedicated rate management team that constantly works with data, cleansing, validation, and all of that. Key thing about Xeneta is that it's independent and neutral. There's no ownership stake in the company from either the buyer or the supplier side of the industry, which means that we are in a good position to provide this kind of intelligence without compromising the business of any of these stakeholders. Now, it's key to understand before we go into the findings and the developments where we source the data. And I mentioned it briefly, but if you take this very simplified approach, we get it from either the shipper or the consignee in a supply chain. The ones who's in control of the actual shipments and the contracted rates, those connect to the platform and upload their contracts. As mentioned, we also do source data from freight forwarders and NVOCCs, but whatever data it is, whether it's named account basket rates, named account contracts, FAK, it's tagged so that the users can segment out which data they would like to have a look at. And I'm going to show you this once we start using the tool live in this session. Before we go into that, I want to talk a little bit about the market, how it currently looks like, and what challenges we see going forward. There's still a significant amount of overcapacity, which in theory makes or puts the carriers in a weaker negotiations position. But it's also been 2016 has also been a year with some events like the Hanjin saga that they went bankrupt, and there's been a lot of M&As, and the market at some point in 2016 was at such a low level that it wasn't sustainable, and we of course saw that already late 2015 how it developed, and now it's been since March and June for the Trans-Pacific and March for the North European one. It's been trending upwards since, and we're going to look at the charts and we're going to see how it's developed and with how much. But this whole all of these M&As has also created a lot of uncertainty with BCOs, shippers that reports to us about who are they actually contracting, which string specificity do they get when they secure a contract, and what can they expect out of transit time, reliability, and all of that. There's also macroeconomic things. As you all know, there's been a change of presidents in the US. There's a lot of uncertainty. How will global trade develop with that? Will there be flows of cargo going in other directions, and a lot of uncertainty for both the buyers and the suppliers in the supply chain. As I mentioned, the market is picking upwards, and that has also changed the mindset of a lot of our customers, which earlier it's been about for a lot of companies, getting a cheap price, while now it's getting the right price so that they can actually get their cargo moved within their supply chain. So a little bit less focused these days on the cheapest price rather than what is, and more on what is a competitive and fair price to operate with. Another major event we've seen when we close Q4 is that a lot of the negotiations on the Far East Asia into North Europe has been pushed. It's been postponed, the contract negotiations, which is because there's a very uncertain market at the current time. It's trending upwards, but the overcapacity actually dictates that it shouldn't go up this much. But shippers has then stepped aside from the table, and when carriers accept that, you can argue at least that they expect an even better position to negotiate from later down the road. And we all know that the Chinese New Year is coming up, and traditionally we've seen significant rate increases in relation to Chinese New Year. And if those increases sticks in the market, then carriers will actually be in a much better position to negotiate the long-term contract. So it might be a very favorable move from the carrier side as well. And one thing that we said throughout 2016 is that the danger of a slumping market is actually the recovery one, and I think we're right in the middle of that now, and have been for some months, which has completely changed dynamics. And since approximately November, I'd argue that there's been more of a seller's than a buyer's market, and it definitely has been a buyer's market for the previous 2.5-3 years, where there's been a constant downward trending market, and now that's started to pick up, and that's created a lot of internal fuss and confusion amongst the shippers and BCOs that we deal with, and now it's a struggle to get their bearings and to decide which strategy they will do for their 2017 contracts. Now, Some of the main highlights for Q4 on the short-term rates, as we saw from Far East Asia main ports into North Europe main ports, the market average picked up with 33%, while the lower end of the market picked up 13%. And this is for 40 footers. You of course see the same correlation with 20 footers and 40 foot high cube. And this is the values going into the quarter versus the values exiting the quarter. And then on Far East Asia main ports to North American West Coast, still for short-term rates, there was actually a slight dip in the short-term market from when we entered the quarter and exited the quarter. 5% for the market average and 4% for the lower end of the market. Now, if we switch to long-term rates, you will see that for the Far East main ports to North Europe main ports here for a 40-footer, it's interesting to see that if you slice out long-term contracts but remove the old data so that you only look at contracts that went into effect over the last 6 months, there was a 28% uptake on long-term contracts for the average. And if you do the same exercise but just narrow it further down so you only look at contracts effective from within the last 3 months, then the uptake of the average was 43%. And we've made this case now for a long time, saying that the long-term market moves accordingly to the short-term market, but with a delay, simply because of the contracts expiring later on. And this is what we see now on this corridor, that it started picking up in March on the short-term contract, and then in June the longer-term contracts started to follow the same pattern. Different uptakes and then different point in time, but still pattern-wise the same. You see that the lower end of the market for contracts that were 6 months old or newer has picked up with 29%, while contracts with effective from date within the last 3 months has picked up with 31%. Then there's slightly bigger numbers on the Far East Asia main ports into the North American West Coast. For 40 footers here, you will see that 6-month-old contracts has gone up with 41% compared to the full set of contracts for 2016. 84% increase if you slice out the last 3 months contract here, and the lower end of the market for the contracts effective from date within the last 6 months has gone up 54%, while there's a significant bump on the lower end of the market for contracts effective from within the last 3 months of a whopping 129%. So we definitely see the same trend on both these corridors compared to what we saw in the short-term market. And I want to use the tool now to go through these highlights. So I'm going to switch over to my browser, and I've prepared these different corridors. So you'll see here that we're looking at Far East main ports into North Europe main. I've selected a 40-footer, and I've only selected Q4. So this is short-term contracts showing price development from 1st of October, back here, all the way until at year-end 31st of December. So on the y-axis, you have a US dollar value, and then when I move the mouse cursor, you will see the actual US dollar value on any specific date. So we went into the quarter with an average rate for a 40-footer here of $1,416. Then there were a couple of GRIs, one in November that stayed fairly well compared to historical GRIs, and then another one beginning of December and mid-December, which then picked up the market to $1,878 short-term market. Now it's imperative to have a slightly longer time perspective on this. So what I'm going to do is that I'm going to use the slider down here, and I'm going to do a 12-month historical overview. And here you will see what we pointed out earlier, that the market bottomed out in March, where the average sat at 479, and then today, end of year, it was at 1,878, and I can of course push it so that we can see the latest price development all the way up until today, where the market average sits at $2,052 for short-term contracts. Then I can include the spread of the market so that you can see how the lower end of the market has lifted itself significantly to $1,333, and back to March it's sat at 158. Now I want to show this in percentage as well, so you can see how drastic of a change that is. If I go back to 27th of March and I switch this to percent change from start, you will see that the lower end of the market from bottoming up in March has moved up with 744%, and the average has gone up with 328 for a 40-footer. So that's the how the market is moved for short-term contracts from Far East main ports to North Europe main. The reason why this is very important to look at is that this development, these patterns are reflected in long-term contracts. So now I want to look at the same corridor, but long-term contracts, and I'll start by looking only at Q4. So as you can see, long-term contracts, all valid long-term contracts, the average in Q4 was fairly flat, hardly any change, and the average, as you can see down here, we're set for the whole full quarter at $947 and the lower end at $500. And then if we want to see the development over the full year, I'll use the slider here to select the 12-month period from today, and you will see that there's been some movements. But these numbers down here doesn't change that much. Now what's interesting is to see the change in long-term contracts relative to short-term, and in order to visualize that one, I need to segment out the data. I can't look at all valid long-term contracts over a period of time. I need to slice away old contracts. So what I prepared on this slide here is a long-term contract overview for 40-foot container, where I only look at contracts valid within the last 6 months. And then you will see that the market average has moved up to $1,177, which is $230 up from the previous graph we looked at. The lower end of the market has moved up to $621, which is a $121 uptake. And then further on, if you slice again and you take out only contracts valid with starting date within the last 3 months, you will see that the average keeps on moving up to $1,308 and the lower end at $765. Lower end then moved another $144 up, while the average moved $131 up compared to what was valid within the last 6 months. And this clearly shows the uptake I'm talking about. And this is paramount how, if you run your RFQs, your tenders now, these are the relevant benchmarks that you would inject in that, and even slice it one level down further to look at what's been currently negotiated this specific month for long-term contracts, which we have available, of course, to our customers. Final page or graph I want to show on the Far East main to North Europe main corridor is this one. What I've done here is that I've selected future valid contracts. So I wanted to give you a glimpse on what is happening the next 90 days based on contracts with effective from date within the last 3 months. And the point here is that it's a very slight marginal uptake from the previous graph we saw, which might mean one out of two things. It might mean that it's reached a level where it will flatten out, or, as I mentioned earlier, the fact that there's a lot of long-term contracts currently being pushed so that the expiration date is moved to end of February and then end of March. So traditionally, this corridor has been tendered accordingly to the calendar year, but this year we see a huge change in that due to the high level of volatility, high level of uncertainty. Both the supply and demand side has postponed a lot of the negotiations, so that we will continue to get fresh data in over the next couple of months to see how 2017 looks like for long-term contracts. All right, so then I want to cover the other corridor, which was Far East main ports into North America West Coast. As you can see here, I selected a 40-footer, and again, I'm going to start with short-term contracts, and I've highlighted Q4 here, 1st of October, going all the way until year-end, 31st of December. And as I pointed out on the highlights, there was a slight marginal decline on this corridor, both for the average and the lower end. But as you can see, in a more granular view like this, you will see that it also had, we went into the quarter with an average of $1,808, and then it peaked at 2,106 before it bottomed up at $1,511 for the average and exiting the quarter at $1,716. Less movement on the lower end of the market here, but again, key to understand the market will be to see how short-term rates has developed over a longer period of time. So again, I'm going to use the slider to give you an overview of how the market has looked like for the last 12 months. And here you will see that the market bottomed out during Q2, Q3, beginning and end of Q2 mainly, and approximately at $947, $600 on the lower end. Then we exited the year at $1,716. Lower end stood at $1,243, and then you will see a significant GRI effect now in January in this corridor. And same exercise here if I select a point in time where the market bottomed out, 31st of May, for instance, and then flip it so that we can see how the market has moved in percentage. You will see that the short-term market, since it bottomed out in May on this corridor, has moved up for the market average with 139%, and the lower end is lifted with 93%. And again, this is relevant for long-term contracts because now this corridor is tendered April-May, so that the foundation for negotiations on this corridor will be depending on how this continues to develop, as the main chunk of volume, BCO volume, is tendered April-May on this corridor. So if I then switch to long-term contracts and look at only Q4 to begin with, you will see that it was a very flat quarter, entering at $1,276 and exiting at $1,311. Now, the averages, of course, then are very close to that. And if I look at the price development over 12 months, you will clearly see the tender cycle that I just talked about here, for going from 2016 April into May, where a lot of new contracts comes into play, and that shifted the contracts from 15 into 16 downwards. And this year, with the development of the short-term market going up instead, then we will see an increase. So if I do the same exercise here and look at long-term contracts on this corridor, let's see, negotiated last 6 months. So here I sliced out the data, and you will see that the values here are now very different. The market average now sits at $1,758, which is an uptake of $472 compared to the full data set for 12 months. And the lower end of the market sits at $1,106, which is a $376 uptake. And then, of course, the same exercise can be done so that we slice the data even further and look at what's been only contracts that are valid within the last 3 months. And then you will see that the average sits at $2,350, which is another $592 up on the average. Lower end at $1,793, up $687. So there's a clear upward trending long-term contract pattern on this corridor, as well as with the European one. And we see that historically that the Trans-Pacific corridor correlates in terms of patterns and movements as the European one. But since the tender cycle is run after the European one, it comes then with a slight delay. But same principles apply. Short-term market moves first, then the back of these short-term contracts when April arrives then these next long-term contracts will be settled. But there's always, of course, BCOs that and shippers that tenders off cycle, which allows us to capture this data and see how it develops a bit more frequently than on an annual basis. Yes, that will be the walkthrough of the two different corridors that we intended to cover today. And just to mention one last thing before we go into the Q&A session. Whoever runs, from a BCO shipper point of view, whoever runs their RFQs now need to have fresh, valid data in order to set relevant targets in their RFQs. So I believe that is the main value proposition that they should be on the lookout for now with this data set. And then secondly, I think it's key to keep an eye on how the short-term market develops post-Chinese New Year, because if, as we've seen historically, it plummets quickly after that, then it might very well rapidly change from a seller's to a buyer's market again. But if it sticks, the shippers sitting on the fence waiting for these for Chinese New Year to blow over, they might have lost out on the opportunity to contract as they've done historically according to the calendar year for Europe, and then as quickly as possible, to be honest, now for the Trans-Pacific corridor. So these are things that we're looking forward to keep an eye on ourselves. And with that, I want to go into the Q&A session and see if there's anything we can cover here. So bear with me. Need to open the Q&As here.
Hey, Patrick. I think I have the questions here. I believe best I can read some of the ones for you.
Yeah, sure. I got a couple of ones here, Kathy, about what do we mean with the lower end of the market, and that's a brilliant question. I should have covered that. My apologies. So what we do with the lower end of the market is that we do not report the cheapest rate in the market. So we use a statistical function called the percent point function, which slices out the lower 2.5% of the market, which means that we do not disclose, or we provide more anonymity by showing this spread rather than the bottom end of the market. So the bottom 2.5% is hidden, and we define that as the market low. Then there's a question about when, in our opinion, will be a good time for shippers to finalize Asia-Europe long-term contracts. If I hadn't already done it end of Q4, I might be very tempted to wait to the end of Q1, or at least so that I can see what happens post-Chinese New Year with short-term rates. I think it's a big risk that shippers BCOs has taken postponing it, but now it's already done, and it's done with such a huge amount of volume of contracts that I'd be keen on waiting it out closer to maybe end of Q1. There's always this. I gotta stress this, that this is a risk, because if the rate increases related to Chinese New Year stays in the market, then shippers will be worse off waiting to after that to lock it in compared to what they would have been doing it before. But traditionally, it's plummeted after a Chinese New Year, so over the last few years. So might very well be the same, because we know there's overcapacity. Then there's a questions about whether there's any plans to add volume commitment levels to the tool as opposed to short-term, long-term contracts. So, of course, we have a lot of conversations about the whole volume piece here. So let me first explain a couple of things. So we looked into segmenting like volume brackets, so that you will have 10 to 20,000 TEUs BCOs benchmarked against other BCOs with the same volume and the same trade patterns and so forth. But what we found out very quickly is that you will have 10,000 BCO or a shipper outcompeting the rates of a 100,000 TEU shipper BCO, and it has to do with timing very often. And it also has, of course, with the focus they internally have, whether it's whether they have a total landed cost perspective, so that they're more focused on string specificity, or whether they're focused on the cheapest rate in the market, or transit time, or demurrage and the tension. So what we wanted to avoid is to create a platform that allows you to, let's say, you're a 100,000 TEU shipper, then you would filter out all the 10,000 TEU shipper data, and you would lose out on valuable market insight. But what we found out is that if you historically do this benchmarking exercise, you will map out your position in the market, and then the challenge becomes to maintain that position in order to stay competitive. And that way you will indirectly incorporate volume into the to how you read the charts. That being said, we do a lot of customized reporting, and we have volume data, so we're of course able to also play with those kind of analysis. Another slightly related answer to this topic would be to discuss these enforceable contracts. That seems to be more of a focus these days in the industry, because today a contract between a shipper, BCO, and a carrier very often is more like a price agreement than an actual contract, because we see contracts delivered where volume commitments are not being held both ways, either through short shipping or simply not delivering the bookings that the BCO shippers places. Then there's a question about cost to enter the platform, and how do you get access to the platform. So let me do access first. So access is simple. It's an online platform. You go to Xeneta.com, and once you have a username and password through a subscription, then you can log on at any given time from any location on any device. So that's very easy. Then the cost to enter the platform depends on a few different parameters. It will be amount of user licenses and which product. And Xeneta today has subscriptions ranging from $15,000 a year all the way up until $120,000 a year. Now, next question would be, in light of the very volatile 2016, will it be more sustainable for carriers and shippers to move towards a cost-based pricing model than a market-based pricing model? Oh, that's a very interesting question, to be honest. I think it really depends on whether both sides are willing to do that, and especially on the carrier side. I mean, if the market moves up like it's done now, you got to keep in mind that the carriers over the last 3 years has lost something like $16 billion between them, right? So it will be difficult of an argument for a shipper to now come dragging with that if it finally turns into a seller's market, because the carriers need to win back some of their losses. What I do think there's a lot of interest around is to do index-based contracts with fixed validity periods, depending on whether you want to go short or long-term on your contracts. And we, in fact, we're actually setting that up between a buyer side and supplier side, and we've been doing so for the last 4 or 5 months. And that is, of course, an interesting development to secure a competitive rate in the market at any given time. Then a few other questions. How does this data differ from other freight indices such as SCFI or CCFI? So SCFI would be the Shanghai Containerized Freight Index. Let me be very clear about that. That's outbound Shanghai. We cover more than 160,000 different port pairs. So whether you ship from Tokyo to Sydney, or whether you go from Santos to Antwerp, the data is in our platform, which you couldn't be finding on that source. Now, the second thing is that source only covers short-term data. So that would mean that outbound Shanghai, you would find correlating data with our short-term data. But the true value with Xeneta for larger volume BCOs would be the contracted data. And then CCFI, I'm not 100% sure whether that's just another one of the Shanghai Containerized Freight Index indices. So I cannot answer that, unfortunately. Then there's a question going forward whether it's better to agree on short or long-term contracts with shipping lines. Excellent question. So that depends on the flexibility from my point of view and the flexibility from the BCO point of view. If I were a BCO and I had the flexibility to shift some of my volume into the short-term market, I'd definitely consider that option and do maybe 70% on a long-term contract and 30% on a short-term one. But operationally and strategically and tactically, it's very different markets and it requires different attention amount of resources attached to operating in the short-term market. Now, what we've seen a lot of our customers do is that they've gone from fixed annual contracts into shorter time spans in order to capture some of the movements of the market. And that would mean maybe to go from annual fixed fee to quarterly fluctuating prices. Next question would be, so the market low and high end would indicate that you eliminate outliers to segment the normal distribution in terms of statistical sense. Yes, in essence, we segment out that, and we also have outlier detection in our platform so that it's also picked up during the data cleansing process that all data goes through. Another question would be, do you expect carriers engaging in price war due to this influx of alliances? Ooh, interesting. So I'm curious to see how these alliances play out, to be honest. Traditionally we've seen price wars when as soon as the market picks up a little bit, which is the difference for the last 9 months here. So the market has had a GRI and then someone has stuck out their neck and reduced prices in order to try and win market shares because there's so much overcapacity that whatever you can deliver as volume, it has been highly appreciated by the carriers. Now, the main question I have would be whether someone does this now post Chinese New Year, because then it, as I pointed out, it might very quickly change from a seller's to a buyer's market again. And we wrote this piece about carriers being their own worst enemy. Hopefully, from a carrier point of view and for the sustainability of this industry, hopefully no one of them will do that. Hopefully it will stick because we are all dependent, whether it's me personally or whether it's the shippers, BCOs, we're all dependent on having a competitive functional market of carriers out there. Yes, there's a lot of questions pouring in here. Not sure timing-wise whether we still have time for a few, but there's
yeah,
another.
we'll take 2 more questions. So we'll take 2 more. There's 1 more, and I'll put in 1 more after that one.
Yeah. All right. So next question would be from a BCO that says that they have not yet dared to go into index-based pricing because they don't think they are enough of indexes available for a variety of trade lanes that they have. Europe, US, Europe, APAC, Europe, South America, intra, APAC. How do others solve index-based pricing when they have a big variety of trade lanes? Well, I think that's one of the core problems as well. Definitely agree. And I think we're the only source with the vast amount of data that can actually discuss those trade lanes. I know that's been one of the key challenges for larger volume BCOs. We have shippers in our database with more than 7,000 trade lanes around the world. And to do index-based pricing on all of those requires vast amounts of data. And we would have 90% coverage for companies such as that, which would take care of probably 98% of their volume. But that is data density is a it's a prerequisite to do index-based contracts, and it needs to be accurate and reliable for both the buy and supply side, and that's of course one of the reasons why we onboarded the supply side to the platform as well. Then it's a question about how far back we have historical rates for. Well, that of course depends somewhat on what we've received from the users, but to give you these 2 specific corridors that we covered today, Europe you would be capable of going 2-3 years back, US-based one to a couple of years back there as well. And then most other corridors, especially for long-term contracts, would be a couple of years. And that, I believe, sums it up for this session today. Kathy.
Yes, thank you very much, Patrick. We are over time at this moment. We have a lot more questions that we haven't gotten to. We will answer those over email, so just stay alert and watching out for your inbox. We will be sending out the recording as well, so you'll get that by tomorrow, which we hope again that you can share. We'll hold again our quarterly webinars next quarter. We'll also be hosting other webinars as we move along in 2017. If you haven't already subscribed to our blog, we really encourage you to do that. Go to xeneta.com/blog, and we'll be posting our schedule and other information there, as well as interesting blog posts throughout the year. Thanks a lot again, and we wish you a great day. Bye-bye now.